Hey guys, so in this video, we're just going to talk a little bit about leverage buyout, what it means, and illustrate the key principles of what happens in an LBO through a very, very simple example. So let's take the word, right? Leveraged buyout, LBO, leverage and buyout, two separate words. So buyout, I'm sure all of you understand, right? Just buying something out, buying like 100% of something or owning a majority stake in something as opposed to owning a minority stake, right? So it's like saying buying out a flat or buying out a company, buying out 100% or 70 or 80 or 90%, more than 51% of an asset, as opposed to owning 5%, 10%, 15%. That's what buyout means. Leveraged just means debt, right? Taking debt to buy something out. That's all that it means, nothing else. So leverage buyouts typically mean situations wherein players like private equity funds raise their own money. They raise debt as well, which is leverage. And they typically buy out a majority stake in a company. More than 51% could go all the way up to 100%. Now you might think, right? Why would anyone do that? Why would anyone raise debt? You'll have to pay interest. You'll have to pay the debt back. Does it make sense? They do it simply because debt helps kick your returns up. And we're going to illustrate that to you through a very, very simple example. So let's start the example. Let's assume you have a bank balance of 12 lakhs. Okay. You have 12 lakhs in the bank. Let's assume you want to buy a house that costs 12 lakhs, right? So now you can either buy this house purely through all of the money that you have in the bank, or you can do it through a combination of your own money and taking a loan, right? Taking debt from a bank, an NBFC, anyone willing to lend you money. So let's, for starters, assume that you don't believe in the concept of a leverage buyout. You think leverage is stupid. You put all of your money into this house, right? You spent all 12 lakhs that you have to buy this house. So initially you're taking no debt, 100% equity funded, which means it's been funded by you. So when you go to buy this house, right, you're going to need 12 lakhs to buy this house, which are uses of cash once you have the 12 lakhs. But where did the 12 lakhs come from? It came from your bank account, right? It came from you. So you didn't take any debt. You personally put down 12 lakhs and you bought this house. Now, let's just say you're going to buy this house not because you want to stay in it. You're buying this house because you believe genuinely that the value of this house is going to go up by a certain amount in the next 5 years. And at the end of the 5 years, you want to sell the flat and make some money on it, right? So if you bought it for 12 lakhs, you believe right now that it's going to go to, I don't know, 24 lakhs, 36 lakhs, whatever, right? And you want to make that differential. You want to make all of that money. So you're buying the flat primarily for that reason, for an investment purpose. You're not going to live in it. Let's assume you're going to rent it out. Okay. You are, when you rent it out, you're of course going to realize income on the rent, but at the same time, there's going to be a cost of maintaining the house, right? All of the electricity bills, society maintenance bills, house tax, all of that nonsense. And it's income at the end of the day, right? Rent is income. So you're going to be paying tax on the rent minus, maybe, let's assume you can subtract the cost of maintaining the house, right? And interest if you take debt. In this case, we're not taking debt at the start, so you won't have interest. So let's just assume these assumptions, right? So every year you get 10% of 12 lakhs in rent, so 1.2 lakhs. Interest rate on the debt is 5%, but you're not taking any interest. You're not taking any debt, so there won't be interest in this case. Cost of maintaining the house is 10,000 bucks a year, and tax on the income is 20%. So let's just build a simple schedule that tells us how much cash flow you realize personally from owning this flat. Cash flow, I'm saying, for the next 5 years, for the period for which you are going to hold this flat. So your income will be rent, right? Which is just 10% of 12. Let's just assume it stays constant. It doesn't go up, doesn't go down, stays constant. Let's again assume cost of maintaining the house stays constant at 10,000 bucks a year. So you got 1.2 lakhs a year in income through rent. You're spending 10,000 bucks a year in maintaining your house. You've taken no debt, so there's no interest. And then you pay a tax of 20% on the net income, right? Which is the rent minus you're allowed to deduct the cost that you have both in terms of financing as well as operations from your taxable income from this house, and then pay tax on whatever's left, right? So 20% of this, absolutely nothing fancy. Say you save 90,000 bucks a year, you make 90,000 bucks a year from owning this flat, and that sums up to 4.4 lakhs, assuming it just accrues in the bank and you don't realize interest on it. Don't think too much about this. This is just 0.9 lakhs coming in each year, right? Now, you hold this house for 5 years. Assume that the value of the house goes up 3x, because maybe when you bought it, you thought, hey, like a highway is going to come close to this. It's close. It's on the borderline of a newly developing city, and the value of the land and the real estate will go up. And say you were right? The value of the flat went up 3x, right? So the value of the flat in year 5 goes to 3x, right? So that's just 3x of 12 lakhs. 12 lakhs is what you spend for it. That's 36 lakhs. Say you sell the flat at this point. You realize 36 lakhs. You've gotten 36 lakhs. Of course, you'll have to pay capital gains tax on it, but for a second, forget about capital gains tax. Let's say you get 36 lakhs, right? How do I think about the returns that I made in this entire process of owning this flat vis-a-vis the amount of money that I put into this flat initially? So let's just think about that, right? Let's make again, a very simple schedule. First is in terms of cash. This schedule is going to be in terms of cash flow. So let's just put it out there, right? First is your own money put down. So you put down 12 lakhs, right? You bought this house for 12 lakhs. You put all of your money down, you didn't take any debt, right? So that happened in year 0, at the end of year 0, and then you held it for another 5 years and you sold it in year 5. When you sold it in year 5, you got 36 lakhs and the cash flows came in from here, right? You got 36 lakhs in year 5. Pay down. But when you get this 36 lakhs, right? If you have debt on this flat, you will have to pay down the existing debt, and whatever is left will be yours. So in this case, we did not take debt, but if we had taken debt, we would have been paying that debt amount in the 5th year. And net cash flow from owning the flat in terms of income is like we mentioned above, right? Just copy paste. You're getting 90,000 bucks a year, nothing fancy. So now let's just look at the cash flows, net cash flows for each year, right? Year 0, we spent 12 lakhs. Year 1, we made 90K. Year 2, we made 90K. Year 3, year 4, we made 90K. Year 5, we made, actually year 5, we made 36.9 lakhs, right? Why? Because we made 90K through rent. And at the end of the year, we sold the flat for 36 lakhs and we did not have any debt to pay down. So all of the proceeds were ours. Now let's compute the IRR from this kind of scenario, right? So I've just chosen an IRR formula with these cash flows, nothing fancy, assuming it happened exactly 5 years down the line, and we get an IRR of 30%. Now don't focus on whether this IRR is a good number or bad number. Think about this cell in particular, right? Initial amount of debt. Suppose we had taken debt initially. Would our IRR have gone up or would it have gone down? Let's just try it out and see, right? Let's just put it here and run it from here so we can see it here, right? Initial debt. Let's call this, now let's just say 50%. Let's just assume instead of 0%, we had taken 50% in debt, which means we put down 6 lakhs and we took 6 lakhs in a loan from a bank or an NBFC. So let's just link that here, right? Let's just link this to this. Now, before I press enter, what do you think is going to happen to this 30? Is it going to go down to 25, 20 or whatever? Or is it going to go up to 35, 40? It's going to go up, right? I'm going to show you why. So we've put this here. There you go. It's gone to 44%. Why has it gone to 44%? Simply because now when I bought the flat, I only had to put 6 lakhs down, right? And when I sold the flat, I got 36 lakhs. Of course, I had to pay the 6 lakhs down in debt, assuming that I didn't have to do any principal repayments of this debt throughout the years, throughout the 5 years. And I got 30 lakhs instead of 36 lakhs here, but I only put 6 lakhs. So my returns effectively on a MOIC basis, which is multiple of capital invested, almost 5x, right? I made 5 times my money. I put a certain amount of money and I made 5 times versus earlier, I think it was 12 and it was 36, which is 3x, right? So my returns got bumped up. That helped me bump up my returns, right? So for that reason, using this very simple example that I gave you, this is the prime principle through which leverage buyouts work. Private equity funds take on leverage to buy out companies and then use the cash flows of the companies to pay down the interest and the debt, because leverage levers your returns. It pushes your IRR up. That being said, I think we've covered the LBO basics. Now let's move on to the next tab, which is LBO counting. So if you understood the basics of an LBO, just philosophically as to why debt kicks returns up, I think you're in a good spot. But that being said, you also need to understand the accounting implications of doing a leveraged buyout, right? It's not complicated, but there's just a couple of things that need to be understood, even if the overall principle is clear, just from an accounting standpoint. So let's begin with this, right? Let's begin with this example, right? Let's say there's a company A that we want to acquire, and we are a private equity shop, assume that focuses on buyouts, leverage buyouts. This is the balance sheet of the company just before we acquire it. So let's assume they have cash of 10 bucks, fixed assets of 90, working capital of 50, no goodwill. This is the total assets. On the liability side, they have combination of this, right? 75 debt, 75 equity, no minority interest, balance sheet is checking, everything is perfectly fine. Now, say as a PE fund, I want to raise capital through debt and my own capital through equity to buy out this company. Say I buy out this company at 2 times its book value, just being nothing but the equity value. Now, don't be worried about what book means. Typically in investment banking, private equity, people talk about multiples, right? EV by EBITDA, price to earnings. Assume that this acquisition is happening at a certain price to earnings or an EV to EBITDA. We don't have those numbers here. We don't care about those numbers, and just assume that that translates to a price to book of 2. What that means is if the price to earnings was say 20, and then you got a certain equity number in terms of the final market, the final equity value of the company, and say that final equity value divided by this 75 is 2. That's what we're trying to say over here, right? So assume price to book of the company is 2, the acquisition P by B. Hence, the equity purchase price becomes 75 into 2, right? Like we just discussed just now. So that's 150. That means to buy out this company completely, I need to pay the existing equity holders of this company 150 rupees to acquire all of their shares, even though the book value of their shares is worth 75 bucks and not 150. So I'm paying twice, right? Now, as usual, right? Okay, let's assume this is 100. Say we acquire 100%. It's a buyout, right? We're buying on 100%. As usual, the question arises, right? If we need to buy out 150 bucks worth of shares, we have to raise that money, right? Either through ourselves, which will be equity, or through debt, or through a combination of both. So let's just assume the split is 50-50. So of this 150, let's say 75 comes through equity, 75 comes through debt. And say we raise that in a shell company, which is a company that has absolutely no assets other than the cash that we've just raised, 75 through debt, 75 through equity. We raised all of that, and that is showing up in cash, and there are no fixed assets, there's no working capital, there's no goodwill, there's nothing, right? Just 150 bucks in cash to pay out the existing shareholders of company A. Now, what I'm about to tell you is a structure that I'm going to talk about in terms of how this shell company is going to merge, is going to acquire and merge with company A to form a new entity, right? which will have certain accounting implications that we will cover again once we start building the model in the case study. But if you just understand the core principles here, everything will be fine. So let's just begin, right? Let's just assume the shell company acquires company A, and how does it do it? It uses the cash, this 150 bucks in cash, to pay out all equity shareholders. So what it means is in the final entity, this 150 of cash will not be there. It will not exist simply because it is being used to pay out existing equity holders. But that also means this 75 will not be there, right? Because these shareholders and their value of that stake doesn't exist anymore because I'm buying it out. So how will the final merged entity look like in terms of the balance sheet? So let's go line by line, item by item. So in terms of cash, the cash will just be cash from company A. That's not going anywhere. Why not cash from company B? Because I'm using that to pay off these equity holders, right? So that's gone. Fixed assets will just be the sum of both. 90 plus, this didn't have fixed assets, so it'll just be 90. Working capital will be again sum of both. This company had no working capital, this had 50, so that's again 50. Goodwill, right? So what is goodwill? Goodwill is like a plug figure. Now let me explain to you what I mean by that. It just means every time you pay for something which is above its book value, from an accounting perspective, to maintain the balance sheet check, right? You're going to have to create an item called goodwill. So if something is worth 100 bucks and I pay 200 bucks for it, right? The goodwill created is 100 bucks. So in this case, I paid 150 bucks for something that was worth 75, right? So I got a goodwill of 75. But that's of course we've got to make sure we index it for the stake as well, like 100%. This is important. Keep note of this. So we have total assets of 225. And let's go to the liability side, right? So debt, again, nothing but sum of the two. We're making a simple assumption here that we're not paying down the debt of company. That's usually not the case, by the way. When you typically do a leveraged buyout, the target company's debt is usually paid off. But just to keep things simple here, we're not paying down the debt, right? So it's just going to be 150. That's it, 75 to 75. Now let's go to equity. This gets really interesting. The value of equity on the balance sheet, in terms of the book value of equity on the balance sheet of the final entity, will just be the book value of equity of shell company B. This is going to go to zero. Now, why, right? You can ask me why. Why? Because we're buying out these guys, right? We're buying these guys out from this 150 bucks in cash that we had, that's creating this goodwill. But this cash is disappearing in effect, and so is this amount, right? So from this side, 150 is disappearing, from this side 75 is disappearing, and the plug is the 75 of goodwill. That's what's happening. And then minority interest. In this particular scenario, because we're acquiring 100% of company A, there is no minority interest being created. But if we were to acquire 70%, 80%, 90% of company A, right, there would still be 30%, 20%, 10% of shareholders that are minority shareholders who have not been bought out. And we need to reflect that in the balance sheet. So from that perspective, we have the balance sheet, it's checking, everything seems fine. This is what the final pro forma balance sheet of company A is going to look like after the leverage buyout has been executed. Now let's just play around a little bit with this number 100, just to give you a sense of, if I make this 80, right, what will happen? You'll get minority interest that gets created because 20% of this number has not been acquired, right? And that's showing up here. And 80% of this is being acquired at 2 times book, right? That's why it's showing up at this. You in essence get the principle, right? Of like why we're trying to do this. So if all of this has been clear so far, it is really good because it means that you've understood the core principles on how to think about a leveraged buyout, and we're going to cover a leveraged buyout case starting in the next video. See you guys there. Bye.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.